Hello friends, this is Rajat Dar, and so today as Sensex has touched the all-time high of over 64,000 and Nifty by over 19,000, the next question that is coming up is, should I be selling stocks at such a high value or should I continue being stick into the market to gain more traction into my stock portfolio? So here I will be telling about the strategies which you as an investor can take advantage of to wade through this market sentiment. So here in this video, we'll be covering 6 strategies in a very short span of 2 minutes. So first strategy is the profit booking. So the basic question is, if you want to do the profit booking, how to do the profit booking? So there would be many stocks and many funds in your portfolio that would have given 50%, 60 or 80% returns, or and even some which would have given 100% returns. The thumb rule is you can make a partial profit booking, and that partial profit booking could be 25%, 50%, or a 60% of the profit made on the stock. While it will enable you to secure your holdings and secure your profit at one end, and on the other end you will still be invested into the stock to take advantage if any further gains happen in the stock. So this is strategy number 1. Then the second strategy comes about the tax loss harvesting. While you are having a portfolio of say 50 stocks or a 20 stocks or a fund having 10 funds, there would always be some of the funds which are not performing well. Now, if those funds which are not performing well because there is a fundamental problem with the company or a stock, or the sector cannot be seen as turning around in next 1 or 2 quarters, so while you have booked profit at the one end, you can reduce your tax bill by booking the loss on some other, so that you can net off the capital gains in short term and long term against the corresponding tenure of the losses, so that your tax bill reduces further. So this is strategy number 2. The strategy number 3 is stop loss. So normally we know that when we are acting as a trader, what we do, we have taken a stock and then we do a 10% or an 8% stop loss on it. Now here you have to do it another thing altogether. What you can do is, you are already holding stocks which have gone up by 15, 20, 30% up and even 50% up. You can put on the current market price the stop loss of 8% or a 10%. So what does this mean? This means if while you have already made a profit of 50, 60%, so you will wait. If stock corrects by 2 or 3% or 4%, I'm not worried. But if it falls by around 8 to 10%, then automatically I will exit. So by this method, what would happen? See, while you have already gained 50%, and if it comes back by 8%, you will already be booking 42 to 44% profit and coming out of the stocks. So you can use stop loss as a strategy by which you can exit. The next would be rebalancing of the portfolio. Now, it all depends upon which type of life stage you are, when you are needing money. So if you're invested into the stocks and mutual fund, but you have big expenses coming up maybe in a year or two, then you might have to manipulate and tread the path in the similar fashion in which you can book the profit and come out of it. If you have a long term goal and not needing the money, you can still be put. However, rebalancing has to be done in a very simple manner. For example, you are having a portfolio of 50% debt and a 50% equity based on your risk appetite, time horizon, your financial goals, and your initial asset allocation. So if it is 50-50 initially, now since the stock market has gone up, that 50-50 ratio of equity and debt has transformed into 75% equity composition and 25% debt. So what you could do is, you can again rebalance. So you will make a 25% profit booking and move that money by selling of stocks to again investing back into equity, yeah, debt funds, bonds, or FDs, thereby again recalibrating your portfolio back to 50-50 ratio. So in this way, there will be two benefits. First benefit would be, you would have booked the profit of all your financial assets that have gone up in value. Point two will be, you would have reduced the risk because you are again back at 50-50 allocation between debt and equity. And one more additional advantage would be, because bonds and FDs are having a higher rate of return, so you, whatever you are putting into a fixed income portfolio or an asset, will enable you to have a higher uh, amount being allocated to a fixed income. So you are now getting a compounded effect on the returns as well as the capital that you have generated. Then the second comes about the laddering strategy. Now, what does the laddering strategy means? It is a reversal of, you can say, SIP. So normally SIP, what happens? We keep on investing every month a certain amount into a stock or a mutual fund. But when the market is going higher and higher and you don't know when to exit because nobody can time the market, the next best strategy is you can periodically sell in tranches. So you will say that, okay, I have a 10 lakh of holding in, say, for example, A, B, and C stock, and the market has gone up by around 50, 80%, the stock. So, but I don't know whether I should take it in a single go or not. So you can do the profit booking in a tranches of 5% each every week or every month for that matter. So this way, this is called as the laddering strategy. The fourth, the fourth, or we can say that the next strategy that we, sixth strategy that we can look forward to is capital tax strategy. So what does capital tax means? If we see in the last 1 year, there are many of the funds who are nearly covering 12 months. So there might be a stock that you are holding, say, for last 11 months. And now in the last 2 months, it has given a total annualized return of, say, around 20% or a 30%. Now, since the stock has gone up rapidly and there is still 1 month to go, and if you are seeing that the sentiments are going to remain bullish over next 15 to 20 days, so the prudent strategy is to hold on for next 30 days and wait for the 1 year to be completed, because short-term capital gains is taxed at a higher rate of return, high rate of interest, while as the long-term capital gains is as a smaller rate of interest, or you can say the tax rate. So therefore, by way of balancing your short-term and the long-term capital gains, you can still reduce your tax bill and your net gains would eventually increase. The next strategy is the use of options. Now, for all those clients who are having a bigger portfolio, stock portfolio, but do not want to buy and sell stocks at a high because you're not quite sure, but you still want to ensure that while my stocks are going high, if the market goes down, my capital is protected. So, those advanced traders or portfolio managers use options. So, what you can do, you can buy a put option, and but that the quantum of the put option should be in tandem with your portfolio size. So if your portfolio is of 1 crore or your portfolio size of stocks is say 50 lakhs, then accordingly your beta of the portfolio should be matching with the option strategy, so that if the market goes down and your portfolio value gets eroded by 1 lakh, the 1 lakh by means of the gain in the put option should be there. So that is how the option trading happens. Now, in my future videos on all of these 6 to 7 strategies, I will be doing separate videos. So stay tuned with me and have happy investing. So these are the 6 to 8 strategies that you can deploy in terms of managing your portfolio and knowing when and how to come out of the portfolio at such highs. Thank you so much.